It is Monday, December 22nd, 2025. And if you're just joining us right now, you need to put down whatever you are doing. Stop watching the football highlights. Stop scrolling Instagram, because the financial system you went to sleep with on Friday night no longer exists. Ladies and gentlemen, Asian guy here, we warned you this was coming. We told you the banker flip was the signal. We told you the January 1st lockdown would be the trigger. But I'll be honest with you, even I didn't expect it to happen this fast. I'm looking at the live feed from the COMEX right now, and silver didn't simply open. It detonated. At 6:05 p.m. EST yesterday, when the Globex markets opened in Asia, silver was priced at $66.50. 1 second later, the very first trade printed at $68.40. There were no trades in between. No $67, no $67.50. Just a vertical wall of empty space where sellers used to exist. That gap alone is terrifying for the shorts. But that isn't the real headline. The real headline is what is happening in the physical market right now as we speak. Because while the paper price in New York is struggling to break $69, the real price, in the only market that actually has metal, Shanghai, has just shattered the sound barrier. I have the official data from the Shanghai Gold Exchange, the SGE, right here. At the close of the afternoon session in China today, the benchmark silver price hit 1,648 yuan per kilogram. Let me do the math for you. Because the mainstream media is too terrified to show you these numbers, 1,648 yuan per kilo divided by 32.15 ounces per kilo equals 50.2 yuan per ounce. Converted at today's exchange rate, that works out to $71.57 per ounce. Do you see the problem? Silver is trading at $69 in New York. Silver is trading at 71.57 in Shanghai. That is a spread of nearly $3. In a normal market, that is impossible. In a normal market, a bank like JP Morgan or HSBC would buy the cheap silver in New York at $69, ship it to Shanghai, sell it for $71, and pocket the risk-free profit. That process is called arbitrage, and it keeps global prices locked together. But today, the arbitrage is broken. The gap is just sitting there, $3 wide, screaming at the world. Why isn't anyone closing it? Why aren't the banks buying the cheap silver? Because they can't get the metal. The cheap silver in New York doesn't exist. It's a paper ghost. You can buy the contract, but try to take delivery. Try loading 1,000 bars onto a plane headed to China. You can't. And that brings me to the breaking news that hit our desk just 10 minutes ago. The news that confirms this isn't just a banker war anymore. This crisis has officially spilled over into Main Street. We just got off the phone with our contacts at major U.S. bullion dealers. We checked APMEX, we checked SD Bullion, and we checked the biggest of them all, JM Bullion. Here's the situation. If you go to JM Bullion ES website right now and try to buy a 1 kilo silver bar, the standard investment bar for serious stackers, you're going to see a sea of red text. Sunshine minting 1 kilo, out of stock. Silvertown Pony kilo, out of stock. Valcampi Swiss kilo, out of stock. Pamp Swiss kilo, out of stock. We're talking about the bread and butter of the retail silver market, gone. At the moment, 24 different types of kilo bars are listed as out of stock on their site. Only a handful of high premium collectible bars remain. This is not a coincidence. This is a run on the bank. Over the weekend, when news of the January 1st lockdown leaked, the smart money didn't wait for Monday morning. They went online and they cleared out the inventory. And it's not just the big bars. Look at the 100-ounce bars. Look at the 10-ounce bars. Pre-sale notices are appearing everywhere. Expected ship date, mid-January. Expected ship date, February. Do you know what that means? It means they're selling metal they don't actually have yet. They're selling metal they hope to receive from refiners. But the refiners are now declaring force majeure. We have unconfirmed reports coming out of Mexico this morning, specifically from the Fresnillo operations, that shipments to U.S. refiners have been halted due to security concerns and logistical renegotiations. Translation? China just offered $71.57. America is offering $69. Where do you think the metal is going? It's flowing to the highest bidder. And right now, that bidder is Shanghai. That's why your local coin shop is empty. That's why online dealers are sold out. The supply chain has snapped. Silver is being sucked into a black hole in the East, while the Western consumer is left holding a fistful of depreciating dollars. Now, I want to pivot to the financial side of this disaster. Because as bad as the physical shortage is, the paper emergency facing the banks is even worse. We talked on Friday about the banker flip, how U.S. banks went net long while foreign banks went net short. This morning, we're seeing exactly how that bet is paying off. When silver gapped up to $68.40 at the open, it triggered something called a gamma squeeze. I won't bore you with the calculus, so here's the simple version. Wall Street sold millions of call options, bets that silver would go up. Most of those bets were struck around $65.66. As long as silver stayed below 65, the banks were safe and those options were worthless. But when silver opened at $68.40, millions of options instantly went in the money. The banks that sold them are now legally required to deliver silver they don't have. They were naked. So their algorithms, the automated trading systems that run Wall Street, kicked in. The rule is simple. If we're losing money, hedge immediately. How do they hedge? They buy silver futures. So at 6 p.m. last night, millions of buying algorithms woke up and started smashing the buy button at any price. That's why you saw the gap. That's why silver is sitting near $69 right now. This is a forced liquidation of the bank's own risk desks. And hanging above us like the sword of Damocles is the $70 strike wall. There's a massive concentration of open interest at $70. If silver crosses $70 in New York, just $1 away, it triggers another wave of automatic buying. It becomes a feedback loop from hell. Higher prices trigger buying. Buying triggers higher prices. Higher prices trigger more buying. And remember, the price in China is already $71.57. The magnet is pulling us upward. The gravity of the physical market is dragging the paper market, kicking and screaming towards $71. The banks can't stop it. They can't tamp it down like they used to. Why? Because tamping it down requires short selling. Who's going to sell short when U.S. banks are long? Who's going to sell short when China has banned exports? If you sell short today, you're signing your own death warrant. The smasher is gone. The tamp down team is on vacation. And the market is floating freely into the vacuum. Let's go back to Shanghai for a moment, because I want you to understand why silver is $71 there. This isn't speculation. This isn't a bubble. This is desperation. We've been tracking inventory levels at the Shanghai Futures Exchange. Last month, they held around 400 tons of silver. This morning's data shows a clear drawdown. But wait, China is the world's largest importer. Why are inventories falling? Because the solar industry is consuming everything. We found a report from Mincham, India, dated December 11th, 2025. It warned that China's record low silver inventories pose a global solar supply chain risk. It detailed how the shift to N-type TOPCon solar cells has increased silver consumption by 30-50% per panel. China produced over 400 gigawatts of solar panels this year. Do the math. That technology shift alone adds roughly 60 to 80 million ounces of extra silver demand. That's why they banned exports. They aren't trying to squeeze the West. They're trying to keep the lights on. They looked at their warehouses and saw the bottom. They realized that if silver leaves the country, their solar factories shut down. And since solar is the backbone of their energy independence strategy, that outcome is unacceptable. So the $71 price tag in Shanghai isn't a financial number. It's a bid for survival. It's Chinese industry saying, we'll pay whatever it takes. Just get us the metal. And here's the scary part for the West. China has the cash. China has the trade surplus. China has the ports. The U.S. Mint has a budget and strict statutory limits on what it can pay for blanks. If the U.S. Mint can only pay spot plus $2, and China is paying spot plus $5, where do you think the silver from Mexico goes? It gets loaded onto a ship in Manzanillo and sails west across the Pacific. It never touches American soil. This is the sucking sound Ross Perot warned about. But it's not jobs leaving. It's strategic resources. Even mainstream analysts, who usually dismiss silver, are throwing in the towel. We just saw a report from MK Global, normally very conservative, admitting that silver AS rally is being driven by tight physical supply in London and China, with prices expected to reach the $70 to $80 range by March. They cite rising exports to the U.S. as a source of imbalance, but that was old data. That was last month. Today, exports are stopping. If analysts are bullish, based on outdated numbers, imagine how bullish they'll be once they realize Chinese supply has effectively gone to zero. This is the moment that wipes out the shorts. If you're short silver, your entire strategy depends on one thing: futures trading above spot. You sell high, you buy back lower, and the spread pays you. That only works in a normal market. But backwardation flips the game upside down. Now you're selling low and being forced to buy back higher. Every single day you hold that position, you bleed cash. And with lease rates exploding to 32%, the cost of staying short has become unbearable. This is why we are calling today the Monday Massacre. The shorts are being crushed from three directions at once. Price, Shanghai is already at $71. Cost, lease rates have detonated to 32%. Structure, backwardation is punishing shorts by nearly $3 per ounce. There's no escape hatch. There's no clever hedge. There's only one exit: buy. And to buy, you need a seller. But the sellers just declared force majeure. While bankers in London are panic bidding for leased metal, the physical supply chain in the Americas is snapping in real time. All morning we have been tracking a developing story out of Mexico, the world's largest silver producer. And if Mexico stops shipping, the game is over. We have now seen copies of letters sent by Fresnillo plc, the giant of Mexican silver, to multiple major U.S. refiners. These letters formally invoke force majeure, the legal nuclear option that allows a producer to walk away from delivery obligations due to uncontrollable events. The letters cite two triggers. First, critical supply chain disruptions caused by China's export ban on precursor chemicals. Second, regional labor instability, a polite way of saying miners are striking because they know silver is worth $71 and they not being paid like it. This is the domino chain we warned you about. China bans exports, U.S. refiners lose chemical inputs, Mexican mines lose refining support. Production stops, force majeure is declared, and suddenly the U.S. Mint doesn't get blanks, Apple doesn't get contacts, and you don't get silver bars. This is why JM Bullion is sold out. They didn't just sell everything, the pipeline itself went dry, and if you think you're safe because you own paper silver, this is where things get dangerous. Millions of people are making a catastrophic mistake right now. They see silver at $70, they open Robinhood or their 401k. They buy SLV, they think they bought silver, they didn't, they bought a tracking error. In normal markets, ETFs track price reasonably well. But in a force majeure market, where metal cannot physically be sourced, ETFs turn into traps. Read the prospectus. We did. Most silver ETFs include a clause stating that if physical metal cannot be obtained, the fund may settle in cash at the prevailing market price. Here's the nightmare scenario unfolding. Physical silver trades at $100. COMEX is frozen at $75 due to halts. The ETF declares it cannot source metal. They close your position and send you $75. You walk into a dealer to buy real silver. The price is $120. You lost the spread, you lost purchasing power, and you lost the asset. This is why unallocated silver accounts are lethal in moments like this. If your silver is unallocated, you don't own metal. You own a claim on a bank's balance sheet. You are an unsecured creditor. If the bank fails or declares force majeure, you don't get silver. You get a seat in the bankruptcy line. In backwardation, there's only one safe position. Allocated physical metal, either in your hands or stored in your name with serial numbers that belong only to you. No serial number? You're the product. Now zoom out. Why now? Why December 2025? Solar demand is the cover story. This is actually a currency war. BRICS nations spent years hoarding gold. But in 2024, they realized something critical. Gold is money. Silver is everything. You can run a country without gold. You cannot run a modern economy without silver. No silver means no missiles. No silver means no 5G. No silver means no green transition. By cornering silver, China isn't squeezing traders. It's squeezing the Western economy itself. If silver goes to $100 or $200, the dollar collapses against real assets. The January 1st lockdown is effectively a sanction. You sanctioned our chips, we sanctioned your silver, and the US has no counter. We sold our stockpiles, we closed our mines, we outsourced refining. We are naked in a blizzard, and China just took our coat. This ensures the crisis doesn't resolve quickly. You can't print silver, you can't negotiate it back. Backwardation and extreme lease rates aren't temporary, they're the new baseline. Now look at the math, the cold, brutal math. Global production, 840 million ounces. Global demand, 1.2 billion ounces. Structural deficit, 360 million ounces. That was before the ban. After January 1st, China traps, around 15% of supply. Force majeure in Mexico removes another, probably 10%. Western supply drops to 634 million ounces. Western demand remains 800 million ounces. New deficit, 166 million ounces in the West alone. And here's the impossible part. Foreign banks are short 215 million ounces. There's literally not enough silver in the Western Hemisphere to close those shorts. This is mathematical failure. And when markets hit mathematical impossibility, price doesn't rise gradually, it detonates. At $150, people sell jewelry. At $150, scrap flows. At $71, nobody sells. That's why $100 isn't extreme. It's conservative. And now things are accelerating faster than anyone expected. For 20 years, silver was controlled by suppression algorithms, high-frequency trading bots programmed to sell every rally. They worked in 2011. They worked in 2020. Today, something unprecedented happened. At 10:42 a.m. EST, the algos flipped. Order flow data shows massive machine-driven buying, not selling. The very systems that crushed silver for decades are now chasing it higher. Why? Because math changed. We broke the 20-year resistance line. Mean reversion models failed. Momentum protocols activated. The code now says breakout plus volume plus. Shanghai spread. Cost by everything. The smasher became the pumper. And with no miners selling, because force majeure, the machines are bidding into a vacuum. This is a liquidity black hole. Price can jump dollars in a single tick because there are no offers. And when computers decide price should be infinity, Exchanges panic. COMEX has a kill switch, and they just pulled it. At 1 RPM, EST, silver futures locked limit up at 69.50. 14,000 contracts, 70 million ounces, sitting on the bid. 0 sellers. Not one. This confirms everything. The sellers are gone. The shorts are trapped. Western price discovery has failed. While New York is frozen at 69.50, Asia is already trading above $72. Tomorrow, the limits reset. The market will gap higher and likely lock again. This is the death of a futures market and the birth of a physical squeeze. And this time, there is no reset button. For 45 years, silver's price was a lie, enforced by paper contracts and machines. Today, the lie died. Silver is rare. Silver is essential. And there isn't enough of it. When truth breaks free, it doesn't whisper. It explodes. This is the silver squeeze. It's real. It's here. And it's just getting started.